Just looking at some of the previous speakers, and you've clearly gone through some of the banking perspectives from perhaps the more mainstream line of thinking. I generally consider it sort of sacrilege to read through a speech, but in preparing the speech, I realized that in conveying fractional banking, the banking system that we live under, and conveying exactly what it is and the problems that it poses, I actually realized that in the short space of time that I have, I wanted to be as accurate as possible with my words. So I am going to read through a speech. I hope it's not going to be a dry, boring read-through speech, and I'm going to try and engage with you guys as much as possible. So I'm going to give it a go, and more than happy to take some questions afterwards. Right, the financial and economic events around the globe of the last 5 years have revealed one very important fact, and that is that the modern banking system is fundamentally dysfunctional. If this fact surprises you, it shouldn't. It's been this way since 1844, believe it or not. In that fateful year, the British Parliament passed the Bank Charter Act of 1844, an attempt to bar commercial banks from engaging in fractional reserve lending. So what is fractional reserve lending? Let's get to the heart of what we're talking about here. Well, back in those days, people would deposit gold, which was the money of the day, for safekeeping in bank vaults. The banks would issue depositors with a signed contract stipulating that the bank was obliged to hand over on demand at any time in the future a specified weight of gold to the bearer of the contract. Okay? So people deposited their gold and got essentially a deposit slip for their gold. These contracts became known as banknotes. Since banknotes were a legal claim to ownership of real money in bank vaults, the banknotes of the most trusted and respected banks came to circulate as money substitutes and were hardly ever redeemed for actual gold. Okay, so we've got a bunch of pieces of paper trading now as money that were claims to real underlying gold. In essence, because banks honored these contracts to the letter, an efficient monetary and payment system arose. So we didn't have to lug gold around anymore. We can actually use paper money that is essentially a claim to real underlying gold. People no longer had to lug gold around, but instead were able to transact in a more convenient medium in paper notes that were backed by gold. The most trusted banks had the most trusted banknotes, since people knew that real gold existed in the bank vaults to back up their paper claims on gold. As a result, and to their great shame, these banks soon realized they could create new banknotes out of thin air with just a bit of paper and ink that looked exactly like the existing banknotes with the exact same contractual stipulations, i.e. a claim on legitimate gold, and lend them out to merchants at interest as if they were backed by gold. But clearly they weren't. They had created these banknotes out of nothing. Since hardly anyone actually redeemed their gold, no one realized initially that the banks had created more contractual notes, i.e. banknotes, than there was actual gold in their vaults. There was now a pile of new banknotes essentially circulating in the economy, mimicking real banknotes that were backed by gold, with no distinction between the two types of notes. And this, in essence, is fractional reserve banking. So that was the genesis of it. It is now vital to understand the fundamental economic nature of this kind of lending, which is what we want to essentially drill into this afternoon. Aside from being a fundamental violation of legal principles and the effective counterfeiting of money, as we have demonstrated above, the fundamental economic nature of fractional reserve bank lending is that it allows for loans to be made with funds that have not been previously saved by someone else. Okay, that's crucial. So we'll unpack that a little bit. You see, prior to any act of borrowing or lending, an act of saving has to take place, right? If my brother needs to borrow 100 Rand and I agree to lend him the money, I must necessarily forego the use of 100 Rand. In other words, I must save in order for my brother to borrow. Quite a simple concept. I think we all pretty much get that. In a fractional lending system, loans are actually created out of nothing, without any prior act of actual saving. New banknotes were merely printed out of thin air. So no one has to forgo consumption in order for a new loan to be made. That's essentially the system that we operate under. Spending as a whole therefore increases. If we increase the volume of, let's put our 1800s hats on, if we've increased the volume of these banknotes that claim to be able to get you gold for real, but in actual fact there's way more than actual gold exists underground, we're essentially increasing the monetary demand for goods and services in the economy, right? Monetary spending increases due to the proliferation of banknotes posing as real money. Initially, this looks like a fantastic economic boom. Anyone remember 2004 to 2007? Shopkeepers quickly sell out of stock. They place new orders. Wholesalers quickly sell out of their stock and place new orders. Manufacturers sell out of their stock and order new capital goods. Business revenues increase, salaries and wages rise, and new hiring of staff even increases. Meanwhile, the injection of large quantities of new monetary liquidity into the economy in the form of banknotes also fuels euphoric speculative bubbles in stock and property markets. Anyone buy a house in 2000? They've done quite well. Anyone buy a house in 2007? Not so well. People experience the feeling of being cash flush. They buy more luxuries, take more holidays, live the good life. Okay, this is the classic characteristic of the credit cycle boom. The problem is all this new spending requires new products. So we're all demanding all these products. The merchants are going to have to provide us with them, right? We've got more money to spend. But although banknotes in circulation have increased, real productive and natural resources are just as scarce as they were before. We can't print minerals, right? They exist underground and they are subject to scarcity. Resources still have to be painstakingly hauled out of the earth at great cost and effort, and then fashioned into machines and equipment which are then used to make consumer goods. The productive process is a long process. The process of creating false banknotes can be done overnight. So as a result of this natural capital and resource scarcity, the rising monetary demand for goods begins to create shortages. Companies can't replenish their inventories fast enough. A shortage of goods arises in the face of the swelling monetary demand, forcing entrepreneurs to raise prices. If you're selling out of stock so quickly, there's going to be this natural tendency for entrepreneurs to just raise their prices. The demand is hitting them so thick and fast. They can do it, and they still manage to sell out of their stock. Goods prices, services prices, property prices, stock market prices all tend to rise. But here's the kicker. As they rise, people begin to feel less wealthy. The purchasing frenzy slows down a bit. Prices are rising. Not as rich as I thought I was yesterday. People book fewer holidays. Prices keep rising as entrepreneurs try to pass on rising input prices to consumers. But all this does is make consumers feel even less wealthy, and purchases slow even more. Businesses who've worked frantically to have enough stock available in their shop floors begin to find an excess of unsold stock building up. Eventually, sales are so poor that the businesses may even have to fold. Okay, so they've been given this false signal of demand through the creation of paper banknotes. They respond by increasing production. Prices rise, revealing this whole process as an illusion. Demand isn't actually as strong as people originally thought. Shop owners have rushed to stock up their stores. Now they sit with large debts, unsold inventories, and they may eventually default on their loans and may have to close down altogether. Back in the 19th century, as loan defaults rose and the unsustainable asset bubbles inevitably burst, confidence in banks rapidly deteriorated. Well, here's the key when that happens. People spontaneously and rationally rushed to get their hands on real gold. They said, this is a contract. The bank has to honor this contract. I'm going to take this to the bank. Of course, they soon realized that as they flooded the banks with contractual claims on gold, it was quickly discovered that most banks didn't have enough gold in their vaults, right, to meet all the claims. This caused even more panic, of course, and the resultant run on the banks, which is almost what's actually been happening in Greece and Spain. This run on the banks, people flooding to the banks to withdraw their gold, forced many banks to essentially declare bankruptcy. The banks had to say, listen, all these contracts, we can't honor them. Unredeemable banknotes, of course, immediately lost their value. I mean, if you've got a note that says it's a claim on gold and now you know it's no longer a claim on gold, unless you can trick someone else into thinking it still is, it's going to lose its value immediately. What does that mean? Huge piles of banknotes stopped circulating, causing monetary liquidity to dry up. Essentially, money disappears. What you thought was money disappears, leading to further declines in previously overinflated asset prices, and a painful deflationary economic depression followed, 2009, in the most recent context. This was, of course, just the hangover from the preceding euphoric paper note, inflation, and asset bubble. So this also starts to give you a new perspective on what a recession is. Recession might not necessarily be the bad thing. Perhaps the prior euphoria that was unsustainable is maybe the bad thing. British lawmakers rightly wanted to avoid these unnecessarily destructive cycles. Had loans been made with previously saved funds and banknotes had not been created out of thin air, a euphoric liquidity-driven boom-bust cycle could not have happened. The ability to create banknotes out of thin air and lend them out to merchants was the chief cause of the resulting and destructive boom-bust and inflation cycle. The same boom-bust cycle we face to this day, and that we're currently facing as a global economy right now. The Bank Charter Act of 1844 correctly declared fractional lending of banknotes illegal and barred banks from defrauding the public by issuing banknotes posing illegitimately as gold substitutes. However, the big however to the Great Bank Charter Act of 1844 is that despite the noble intentions of that act, it contained a fatal flaw, and that flaw torments us in our financial system in 2012. For while the Act forbid the creation of and lending of counterfeit banknotes, it failed to also prohibit another form of unbacked lending that allowed banks to effectively continue doing what they had been doing before. What was this loophole? Banks carried on lending out more than the actual value of gold in their vaults, but now instead of issuing physical banknotes, they simply loaned money by entering values into borrowers' personal account records. Numbers in bank accounts. Anyone familiar with that? So they simply loaned money by entering values into borrowers' personal account records upon which checks could now be written for payment. So they didn't produce actual new banknotes, but they just went and wrote £1,000 on the guy's ledger. And of course nowadays we don't write it down, we punch it into a digital process. Banks had found a loophole that persists to this very day. To this day, when banks make loans out of thin air, instead of printing banknotes and handing them to you, they simply credit. So instead of printing banknotes and handing them to you, they simply credit your account with extra digits. So when you get a bank loan, no one arrives at your house and deposits physical money on your doorstep, right? You get a few digits appearing in your bank balance. These loans, reflected as mere entries in check or deposit accounts, falsely pose, just like the old banknotes of the 1800s, as real money substitutes in the same, though more difficult to detect, way. In 1844, destabilizing paper banknote euphoria had been stopped, but it had merely been replaced by destabilizing check account euphoria. So the banks got clever, they innovated, and the same problem persisted. Put simply, banks continued to lend more money than actual gold on deposit, incurring the same risks and instability as before. This practice of inflating check or deposit account entries out of thin air remains the modus operandi, as I think you can gather, of all commercial banks to this day. The major difference is that back then gold was the underlying real money, whereas today it has been replaced by national paper money. So this is the new gold. Digital technology has not changed the fundamental structure of fractional banking since the 1800s, although it has arguably made it even more pervasive and more of a systemic threat than ever before. Enter the central bank. The very purpose of the central bank and the monopoly currency production privilege it enjoys, the central bank is the monopolist of currency production in South Africa, although you won't hear the Competition Commission complain about that, is to absolve, the purpose for the central bank, the reason for its being, is to absolve commercial banks from the responsibility of holding real gold money in their vaults, for one, and also to print paper money when commercial banks are threatened with bank runs and solvency crises, as we're going through and as periodically happen. So despite noble intentions, the Bank Charter Act of 1844 therefore failed to recognize the creation of check or deposit account book entries out of thin air as economically and monetarily equivalent to the creation of banknotes out of thin air. I can't stress that enough. It failed, therefore, to deal with the fundamental problem, the problem we know as fractional reserve lending or fractional reserve banking. The result of this unfortunate legal mistake in the United Kingdom well over 150 years ago is that today's banking system remains fundamentally dysfunctional. The best we can eventually expect from the system is incessant financial volatility and uncertainty, if indeed we manage to avoid outright financial and fiscal calamity. So this begs the question, how did we get here and why haven't we fixed it? The nub of the problem stems from the symbiosis between politics and banking. The great Washington Wall Street corridor, or the great Santon Pretoria corridor, if you want to bring it home. Politicians seek access to easy channels of finance. Bankers seek favorable regulatory regimes and protections to continue this lucrative yet inherently unstable banking practice. The central bank, a very unique quasi-private, quasi-public institution contrived by politicians and bankers, go read the history of how central banks were started, is the bridge between the two, legislatively authorized to print paper money out of thin air in order to bail out irresponsible banks and governments. Ever heard of something called quantitative easing? That's exactly what's going on. Despite this, as repeated crises demonstrate, central bank oversight of the fractional banking system does not prevent crises. In fact, it guarantees them. The central bank's role as liquidity provider of last resort encourages commercial banks to lend in even riskier and less responsible fractional lending, to engage in that practice, inevitably leading to greater illusory euphoria and subsequent solvency crises and economic disorder. In fact, the two greatest economic crises in American history, the Great Depression and the current Great Recession, have occurred after the creation of the Federal Reserve Bank in 1913. Even the crises that occurred before 1913 were usually the result of legal privileges granted by government to one or more fractional reserve banks that led to this whole boom-bust process. Moreover, economic crises and painful recessions have occurred in every decade since 1913 and have been particularly severe since 1971. Why do I mention that specific year? That was the year that Richard Nixon delinked the dollar fully and finally from gold. In fact, since 1971, despite all our pretensions of financial sector modernism and sophistication, the globe has experienced some of the worst crises in history, including the repeated crises of the 70s, the deep US recession of the early 80s, the Japanese crash of the late 80s, and the global recession of the early 90s, the Asian crisis of the late 90s, the dot-com bubble and bust of the early 2000s, and of course our current Great Recession. On average, about 2 major banking and economic crises per decade. The current financial crisis, therefore, is no financial accident. It is the predictable and logical result of fractional reserve banking and the political legal privileges that make the system possible. The banking system ensures that the globe, including South Africa, remains deeply susceptible to financial crises and destabilizing, destructive business cycles induced by irresponsible fractional credit expansion. only a return to legally sound banking principles, the kind the 1844 Bank Charter Act was after, can remedy this unfortunate situation. And so in closing, I would like to say that this requires the following banking sector reforms. The first reform is the abolition of legal tender laws that protect national paper currencies and give them essentially a territorial monopoly within particular jurisdictions. Second reform is a return to sound commodity money. The third reform is a clear separation between pure deposit safekeeping banking and loan or credit intermediation banking. So two very distinct banking models need to arise. Banks that provide safekeeping and payment clearance services, and banks that actually facilitate borrowing and lending. Monetary deposits must be legally protected by safekeeping contracts. Banks should be legally bound to loan only those funds previously loaned to them by some other yield-seeking investor who is prepared to fully forego the use of those funds for the term of that loan. So we properly intermediate those funds. Someone gives up the use of funds, saves them, lends them to the bank, and the bank then lends those funds on. There's been no funny business, false creation of banknotes or demand deposits. Finally, with sound money and sound banking law in place, bank solvency crises will be a thing of the past. And in the event of certain irresponsible banks making bad loans, because remember this intermediation process, you can still make bad loans, and becoming insolvent, the lack of fractional loans means that such events will not pose systemic financial risks as we see them today. Instead, we will see orderly bankruptcies and insolvencies within the banking system, not the kind of systemic crises that we face in this day and age. In short, with these reforms, the role and function of the central bank will become obsolete, and the institution can then thereafter be disbanded. Thank you very much.